think so, but in this world, which is really run by pseudo Keynesian economics in the form of macroeconomics, with everybody following macroeconomics and not realizing that gold is money and the risk is in credit, of course, anything can happen in the very short term. But it does feel to me like it's time it broke out. And I think if you look at the fundamentals, this also suggests that this is the case, because America has run out of, effectively, it's pretty much run out of its strategic reserve. So that oil prices are beginning to go better. And this is desperately important because the reason there hasn't been a crisis in Japan yet, which, bear in mind, imports 90% of its oil and LNG from the Persian Gulf, the reason there hasn't been a crisis there is that America has been shipping huge quantities, tankers and tankers of oil to keep the prices suppressed. So with that coming to an end, I think we're going to see the oil price go up, and it could go up very substantially because we're not going to see the Straits of Hormuz or the Bab el-Mandeb Straits opening anytime soon. Basically, the Iranians have got no interest in taking the pressure off America. And America has a problem because they don't want to admit they've lost the war. So, we've got this sort of stalemate. Who blinks first? There's a suggestion that America might actually be driven to desperate straits to have another bombing run at Iran. But if they do that, Iran will hit up back twice as hard. And this time, I believe they will also hit Israel very, very, very hard. So the advice to Trump should be, under no circumstances, do that. But so what's as advice to, will he be listening? It's one of the imponderables, I think, Danny. Well, this is interesting because, the reason countries in the past suspended gold standards during the war was because they knew that under those circumstances they wouldn't be able to maintain the standard. They wanted the freedom, if you like, to increase their deficit spending, to fund armaments, whatever. So the idea that the war is bad for gold is fundamentally flawed. Yet, the way it was behaving until very recently was that any strike against Iran or whatever, gold would go down. And I think it was all tied up with some airy-fairy argument that, this prolongation of the war means that you get higher inflation, you get higher interest rates, and therefore the, if you like, the income cost of holding gold increases, therefore you should sell gold. That's what these idiot Keynesians believe. Now that's fine if the situation isn't a threat, if you like, to the status of the currency. But that has changed recently.
Nowhere does that risk cut deeper than in Japan, which imports roughly 90% of its oil and gas from the Persian Gulf. With the Strait of Hormuz effectively choked off and U.S. reserves running thin, Tokyo is staring down a stark reality. Energy costs are about to climb sharply, squeezing a private sector that's already under pressure from a weakening currency. The yen has slid from around 110 to the dollar down to the mid-150s this year, one of the sharpest depreciations among G7 currencies, leaving Japan's finance ministry wrestling with a currency crisis and an energy crisis simultaneously.
In the last week or so, you've seen it sort of turn around a bit, and now we've had some very powerful days in gold and silver when the price of oil has been rising, and also bond yields. So this idea that the situation is bad for gold, I think, is actually washed out of the system now. So this tells me that the big funds, if you like, are beginning to realize that this is actually pushing the risk into credit as a whole, including currencies, and not into gold. So I think it is a fundamental change. So as regards your first question, this is why I think that we have actually turned the corner in price. Can I just make a comment about Turkey? You see the central bank reducing its gold. But what people don't realize is that the commercial banks also have substantial amounts of gold on behalf of their customers. And this gold, if you like, flows back and forth between the commercial banks and the central bank. And the central bank uses it as a means of controlling the quantity of lira in circulation. So it is a monetary tool. We're not talking about gold leaving Turkey. We're talking about gold moving backwards and forwards between the central bank and commercial banks. So the idea that Turkey sold gold is absolutely wrong. Other nations, I mean, occasionally you get, Russia sold some gold, but I mean, for goodness sake, Russia is mining. She's mining, I think, pretty much the same quantities now as China. Azerbaijan, another one which occasionally shows that it's sold some gold. That again, I mean, it's a smaller nation with considerably smaller GDP than any of the major boys, and it's a major gold mining nation. So again, you have this flow backwards and forwards. So I think it's a misnomer to say at this stage that central banks are using gold, if you like, to pay the bills. I don't see that at all. I'm not saying that gold doesn't pay the bills. I'm saying it pays the bills as a last resort. And I don't see where they're yet anywhere, really. Absolutely. And indeed, this has been happening. I mean, the only ones that haven't done it appear to be the Europeans, like the ECB. But interestingly, France claimed that she had recovered some of her gold, not directly from the New York Fed, but she's been adding to her stocks at home. But I mean, Britain, no gold. Canada, well, I mean, 300 tons or something, which is almost nothing. Canada, no gold at all. Germany, France, Netherlands, and all the rest of it, they haven't been in the market buying gold, that's for sure. They're just sitting pat on their current positions. Poland has been buying quite aggressively and looks like it's going to continue to do so. Russia doesn't trade gold with anyone, really. I mean, they probably trade some with China, but that's about it. The answer is that central banks, I think, have been adding to their gold partly because they see geopolitical shifts. But I think also, very importantly, they see the problem with fiat currencies and the increased risk in fiat currencies. And remember that if you are a central bank holding dollars, for example, you will hold those dollars not as a deposit, if you like, on Citibank's spreadsheet or balance sheet, rather, or whoever it might be, maybe even the Fed. What you would do instead is that you would be invested in bonds to enhance your income. And what have been bonds doing? I mean, they've been an absolute disaster. So from the point of view of central banks, if they see bond yields rising from here, then they're not going to want to own dollars, euros, yen, whatever, as part of their reserve assets. So again, it all points to adding to gold, selling fiat currencies and adding to their gold.
History offers an uncomfortable point of comparison here. Back when OPEC hiked oil prices in 1973 to 74, Japan's government debt sat near just 20% of GDP, and even then, inflation still spiked toward 30%. Today, Japan's debt to GDP ratio sits around 240%, 12 times higher, while inflation is running at just 1.6%. If a new oil shock pushes prices up even a fraction of what it did 50 years ago, economists argue Japan's fiscal cushion is far thinner than the raw numbers might suggest, forcing a choice between painful austerity or continued deficit-funded stimulus that markets may no longer be willing to finance cheaply.
I've got a different take from most of the commentaries that I've seen on this Japanese situation. I think everybody's sort of concentrated on why is Besant doing this. He's got a funding problem. He doesn't want that funding problem to increase. Therefore, what he's doing is he's supporting the currency so that the Japanese can, let's say, pledge their U.S. treasuries and not have to sell them. If they need cash back at home, sort of thing. I think this is a pretty weak argument. If you actually look at the situation, the problem is Japan. I'm not saying that America doesn't have problems, but this is a different issue in this case. Japan does have this problem. If you're sitting in, let's say, the finance ministry, you know very well that the reason that the price of oil is around about $75, $78 or whatever it is, WTI, then you know that the reason for that is that your American friends have very, very kindly supplied you with oil out of their strategic reserves. You will also know that those strategic reserves are run down and that supply is about to stop. You can therefore deduce that prices are going to rise significantly. You will also know that 90% of your hydrocarbons come from the Gulf, which is shut off. So you are going to be forced to go out into the market and try and get oil at whatever price. Now, that price is going to be very, very high. This is going to hit your private sector very, very badly in terms of economic activity. The only way you can defray that is to continue with your ultra Keynesian policies of expanding your budget deficit in order to support the private sector. But that means borrowing. And you go and have a look at the borrowing situation. The way in which bond yields have risen has really created a funding crisis insofar as the amount of interest that you now have to pay on your bonds has just gone through the roof. And yet you're now going into the market with the following proposition. I have got a private sector that is collapsing. My tax revenues, therefore, are going down and my welfare commitments are going up. And I need to support the private sector. What interest rate do I pay in order to finance that? And the international markets say quite clearly a lot more than the current level. And this is why the yen has more or less collapsed this year. I mean, it's gone down from 110 down to 164 at one point. Now 159 and change. And this has just made the whole crisis worse. I mean, they are in a debt trap so evidently, more evidently than any of the other G7. Now, anyone who cares to look will see exactly the same footprints, like in the bond markets for the G7. So I think what this was I think it was a combination of the finance ministry and perhaps the Bank of Japan turning around to the Americans and say, look, can you give us some help in trying to stop the rot in the currency so that we can try and stabilize things in the bond market? Please. And Besant, who was a hedge fund trader, knew very well that the carry trade was short yen, long dollar, and therefore ripe for a bear squeeze. So what did he do? He just set about making absolutely sure a bear squeeze would happen. And how much money did he spend on this bear squeeze? I mean, it was just a few euros, which upset a few commentators, if you like, in Europe. But I mean, really, the heavy lifting was done by hedge funds and banks, if you like, closing their positions. And of course, that stops. There's another misnomer in all this, and that is that the idea that you need currency stability for the carry trade to continue. No, you don't. You've got to just think where the profits in this come from. The profits in the carry trade come from two sources. First of all, there's the interest differential, which we all know about, and then there is the currency risk. Now, when the interest rate differential cannot close, then you can see a situation where the currency in which you borrow is going to weaken against the currency you buy. Most of your profits come from currency, not from the interest rate arbitrage. So actually, as long as the yen continues to go down, the hedge funds and others doing the carry trade will be going, whoopee, this is wonderful. Whereas if you read the commentary, it suggests rather the otherwise. I mean, obviously, you don't want to get into a situation where the whole thing is so unstable that you get the sort of volatility that wipes you out if you've got any real leverage in this position. But, I think what's happened is that, they carry on as normal now, and you will see the yen go on down. You will see interest rates rise from 1% to what? Could be 1.25%, could be 1.5%. But is that enough? No way. And it's also interesting, Danny, if you look at what happened the last time we had a similar oil crisis, which was in 1973, when OPEC raised its reference prices in 2 jumps. The first one was from, I think it was something like September 73, but the big one was later on in January 74. Now, as far as Japan was concerned, they had a debt to GDP, government debt to GDP of about 20%. Currently, we're looking at 240% if you use the slightly wider definition. The effect on inflation was to drive wholesale prices up to a peak of 30% inflation. The effect on consumer prices was to drive them up to, again, about 30% at the very, very top, somewhere between 25 and 30%. We are now looking at an inflation rate which, nowadays, by statistical means, that it's all terribly doctored, so it's not immediately comparable. The inflation rate's about 1.6, 1.7%. Now we've got an oil price crisis about to hit Japan. So what's going to happen to the inflation rate? I think it would be a bit bold to suggest that we're going to see the rates that we saw in 73 fall. But I can tell you one thing's for absolutely certain. They're going to be nowhere near the current level. And that gives Japan a huge, great funding problem. So it's not surprising that the finance ministry turned around a couple of months ago and said to the pension funds, come on, be patriotic. You've got to buy our debt, which basically means selling everybody else's, which they've bought. Are they going to do it? I think under sufferance. I mean, they would do some to keep the politicians happy, but really, where's your primary duty? Your primary duty is to the beneficiaries of the fund that you run, whether that's an insurance company or whether it's a pension fund. And so they will continue to hold their overseas balances, particularly since they see that nothing material has been done to correct the weakness in the yen. That I don't know. I did an estimate of the carry trade out of the total foreign ownership of US treasuries. And I reckon that you're looking at about 4.1 trillion, something like that, out of the total of 9.6 or whatever the total is. Now, how I arrived at that was just basically taking the offshore centres. So you've got Cayman Islands, you've got London, you've got Luxembourg, you've got Belgium, you've got you've got these sort of centres where hedge funds and others work their offshore interests. And so if you take all that, now not all that would be necessarily invested in US treasuries.
For decades, conventional market wisdom held that war and rising bond yields were bad for gold, since higher rates raise the opportunity cost of holding a non-yielding asset. That relationship has recently flipped. Gold and silver have posted strong gains even as oil prices and bond yields climb together. Analysts see this as evidence that major funds are waking up to a different risk entirely. Not that gold is dangerous, but that credit and fiat currencies are. Central banks continuing to add to their gold reserves, even through volatile short-term swings, reinforces that same signal. Gold is being repriced as insurance, not treated as a speculative afterthought.
But you can see the sort of scale of things that we're talking about. It also means that the basis of foreign funding of US treasuries is actually potentially very, very unstable. I mean, if it's all speculative money, in effect, supporting the whole caboodle, is this a good thing? I suspect not.
Well, let's also look at, you mentioned the cost of servicing the debt. As it stands right now, the cost to service the U.S. debt is to the tune of around $1.4 trillion. Okay? So we didn't just arrive at this number gradually. This has been a steep increase since 2022, a 3x move in the cost of service of debt. Back in 2021, early stages of 2022, it looked to be around 475 billion or so. Today, 1.4 trillion.
Yeah.
So at what point does this become unserviceable? What happens next?
Well, that I think is the key question, because from the point of view of an investor, if you like, looking at a proposition from the US government, please buy my debt, they'll be looking at that graph, and they'll be seeing also the dynamics behind future bond yields, which clearly point to higher bond yields. And they will assume from that this debt interest is going to rise even further, substantially. This is going to create problems. I mean, it is, if you like, symptoms of a debt trap. The debt trap is already there. We've just had a pause, if you like, in the whole thing. But as it develops, I mean, again, what I've described happening to Japan is exactly the same thing that's happening to the other G7s, including the US. When the oil price starts rising, the private sector economy is going to take the hit on the nose. You're going to get lower tax revenues. You're going to get higher welfare costs. And you're going to get the US government effectively turning around to its creditors and say, we need to borrow more because we've got to stimulate the markets and we've got to stimulate the economy. And so what do the potential investors say? They say, well, thanks, but no thanks. Which means that yield rises above 5%. And once it starts going above 5%, the situation gets worse the higher the yield goes. Am I more likely to buy these bonds at 6% than I was at 5%? No, because the arithmetic has just basically completely screwed it. 7%? Certainly not. It just gets worse. So you've got this situation where the whole thing effectively becomes unfundable. Except if you do it, let us say, off the very, very short end of the yield curve. And this is, of course, is what Besant has been doing. He's been funding increasingly through T-bills. Some people say that he's been yield curve controlled, sort of reducing the purchases, the sales at the long end of the yield curve, and selling debt at the short end. I mean, he's got no choice. He's not in control, which is what yield curve control implies. It's foreign investors and other investors saying, we don't like the idea of a commitment at a 5% yield or 5.3% yield in the long bond for that sort of period of time.